Hello, this is Randy Lindsay with Hawkeye Traders. In my video update today, I want to show you a good example from the Forex market of how volume and price work together and how using Hawkeye technology will help you to get in front of excellent trades. Now, this setup was identified originally by the Hawkeye Fatman. It is our currency strength meter. The Fatman shows us which pairs to trade and which ones to be looking for. The Australian dollar, you can see here, was extremely overbought and ranging just before the markets closed yesterday. You could see the Canadian dollar was nearing an extreme oversold condition. This is a great setup to be looking for because you always want to see a transition from strength to weakness and then from weakness back to strength. To capitalize on that, the price will follow. So if we were to look at our workspace variables and see where this occurred during this period, you can see right when the Australian dollar crossed below its overbought range, this is the point we want to be looking for potential shorts because we're seeing weakness coming into Australian. So the Australian Canadian, we would be looking for potential shorts. Well, you can see at this point price is pushing right back into previous highs. If it produces a new high, then we know that that's going to be a failure. But now if it does not rotate to a new high, we know that's called price action failure to rotate, and we expect to see price come back down again. And at the same time, we're looking at our 60-minute zones. The zone is an active supply zone, which has identified this same region as a location for heavy selling pressure. Price is coming back up into this zone with four failed attempts to produce higher results. And with it being a supply zone, we would expect this to be a high probability sell region. So with the Fatman giving us good indications of a potential sell, with price action failing, giving us a good potential indication for a sell, and with our zones identifying the same thing, the synergy that's there using multiple time frame analysis helps us to see this as a high probability, low risk trade. So when the signal produces a trend, the trend dot goes from a green, white to a red trend, then it's at this point that we look at trying to establish a trade. So when we establish the trade, we can see the amount of risk that we're willing to take in the trade. In this case, it's about 7 ticks of risk, 7 pips of risk, and then we're looking at trying to get out of it about 6 to 7 points. I did it off by one. There it is. So here's a 7 ticks of risk, and then we're getting a 7 times reward profit. So about 43 to 49 tick profit target. So looking at that moving down to this point, a 7-to-1 reward risk ratio is a perfect trade setup. Now these are the types of setups that you always want to be looking for because you're putting yourself in front of energy flow using your Fatman. You're getting yourself in front of selling pressure using these zones, and you're identifying the trade setup using volume, which gives you 1, 2, 3, 4, 5, 6, 7 times 15 minutes of time, letting you know ahead of time selling pressure was entering this market. So when your trend changed and you got a signal to enter, you have all the confidence in the world to take the trade and to take it to its ultimate conclusion, 43 pip profit with only a 7 pip risk. You can learn this method and others by coming to our live free training room or download a copy of our free ebook or come to our live seminars. We're going to be hosting a brand new live seminar online here in the very near future, so watch out for new emails coming out on that. And I look forward to seeing you and meeting you there as well, so you too can learn how to trade the Hawkeye way.